In Investing 101, Dave Bartosiak joins us now for a quick 101 lesson on options. Don't go away. This is going to be so simple. Good to have you on the show.
Good to be here.
And I love the way you break things down.
Yeah.
So you're here to talk about the options chain.
I am.
Because this is important. This is something that traders down here and other professionals and non-professionals watch to get an idea of where a stock, an ETF, or maybe the overall market may be heading. So it's that early preview clue, possibly, that could tip you off. So what are we looking for here?
I like it because basically the way I look at it is the options market is basically showing their hand. They're telling you what they're thinking of ahead of time. And they have to, because you can see what the prices are on each one of these strikes, on the call side, on the put side. You can also see what the open interest is. You can see how much volume has gone out. So you get a ton of information from this options chain. But the way that I like to use it is I like to use it on stocks that are heading into earnings reports. So, perfect example, we just had the big Tesla report that happened, right? Okay, so what I did ahead of that Tesla report is I took a look at the options chain for the option, in this case, that was expiring, right? Because just a couple of days after the earnings report, took a look at the at-the-money call and the at-the-money put. Okay, so Tesla at the time was trading at like $220. So I was looking at how much is the 220 call, how much is the 220 put. You take the two of them and you add them together. So in this case, it was like $18 for the two of these. So you take that, you divide it by the price that the stock is trading at right now. So divided by that 220, real rough math, that's about 9%, right? So the market was basically pricing in a 8 or 9% move on Tesla heading into earnings.
And then what happened?
And then they kind of shot up a few percentage points, stopped, and then started to reverse back down. In this case, the options market kind of overpriced the whole Tesla thing. So what I did personally in that particular case is I kind of knew ahead of time that Tesla had already showed all their cards. We already had the Model 3 release. We had the numbers for that. We had the numbers for Q1 in terms of production. So you had all this other information. And I was thinking, well, what is Elon Musk going to be able to tell me today that I haven't already heard? And for me, the answer was nothing. So I was actually short that. I was short the put and I was short the call at the money. Made a few bucks because Tesla really didn't move all that much.
But the options thought it would move. So that might be confusing to people because are you basically saying there's no guarantee, but there are times that the options do get it right?
Absolutely.
Do the options tend to get it right more than wrong?
They do, but the thing with these options is, one thing that I've noticed is if there is going to be a move, that you'll see the market push it right to the brink of that move. So let's look at Amazon, for example, right?
Right.
Same thing, the options implied like a 10% move in Amazon.
Which did happen.
And sure enough, that's almost exactly what happened.
So basically, the options market is just giving you one more piece of that homework.
Absolutely.
That you should be doing anyway.
Absolutely.
Before you invest or trade.
For sure. Gives you that implied volatility that's inside of there, so you know how much of a move the big dogs are expecting.
Well, thanks for being a big dog on our show.
Woof.